So this Win Wednesday, we're talking about due diligence and how to do due diligence. First off, what is due diligence? Well, due diligence is actually the questions that you take and lead up into to investigate something. So if you're doing due diligence on a flip, then you're looking into inspection reports and permits and things of that nature. If you're doing due diligence on an investment, maybe you're looking at the risks that are involved, how long it will take, what the return of investment will be. Any of the questions that lead you to that potential answer, that's doing due diligence. So when you hear, how do I do due diligence on a multifamily syndication? I don't even know where to start, let alone what the question means. That's all that question means, is what questions am I going to ask? What questions should I ask to figure out if this is the right investment for me? So how do we go about doing due diligence on a multifamily passive income syndication? Well, maybe you don't even know what a syndication is. So you should probably start there, because there is a difference between a syndication that is a multifamily syndication and a private equity fund syndication. See, the term syndication simply means the government allows us to pool money, investor money together to do something. Something or some things, could be multiples. Okay, so a syndication simply means it's going to be under those government guidelines. Now, a multi-family syndication is where the money is pooled together to buy a multi-family property. So that is different than, say, a private equity fund. In a private equity fund syndication, the money is pooled together into a fund that may purchase multiple things. It could do ATM machines. It could do, many of you are already in one, in a mutual fund. It could do crypto. It could do other real estate rentals and build out a portfolio. A fund has all kinds of versatilities, but it's because it's a fund. It's not hard asset based, okay? So that is the difference first and foremost. A multifamily is hard asset based. When you invest as an LP into a multifamily syndication, you are becoming an owner of that property. When you invest in a fund, you're not necessarily an owner of any properties unless it's a single purpose vehicle fund, which some are. So you just want to be clear, and that's a question you would ask when you're investigating funds. So in regards to multifamily, you're probably looking at it because you want great returns on your money. You know that you don't want to be a landlord. You don't want to deal with toilets and tenants. You know that everybody needs a place to live. So you're mitigating a lot of risk there. You know that the numbers are far greater compounding wise on multifamily than it is on single family. Because sure, you could go out and get a single family house, have one tenant, and when that house goes vacant, you have $0 coming in. In a multifamily, it's completely differently. So for instance, you could have 100 families living in a property, and it could take 30 of them to be gone or not paying their rent before you couldn't pay your bills. So the numbers are far greater in multifamily, and the risk is far more reduced. So you want to make sure that when you are investing in a multifamily syndication, that you do your due diligence. So I've created an ebook just for you. Those of you that are looking for passive income opportunities and you want to know what due diligence questions you should be asking before you dive into something like that. Click here and you can sign up to get this free book. It'll be right there, no questions asked. You never have to talk to us again if you don't want to. It's free, it's 100% yours. Now in this book, there's 16 key questions that we hone in on asking. The obvious ones that most people generally ask are simple. What's the crime in the area like? What's the rental market there look like? Is it growing? Is it shrinking? Is the workforce growing? Is this a Class A, Class B, Class C? The class simply determines the amenities that are offered, the age of the property, and any other facilities that are available to them. So for instance, a newer property within the last 5 years is going to be a Class A just because of the age. But a Class A property could also be 10 years old, but it offers a large amount of amenities. And so it's still considered Class A, and it might be an A minus. But those are all topics for another day. We will talk classes in a whole nother subject. Today, we're talking about doing your due diligence. When you ask these questions, you're going to find out so much more about this investment. So aside from the actual property itself, when you're investing in a multifamily syndication, you're investing in a team, and you want to know about that team. So some of these questions that are in there are things like, who is the operator? Who's going to handle day-to-day? Who's the property manager? Some of these questions will come natural to you, but you won't think of them at the moment that you're exploring that, or you're listening in on a webinar. Some of the other questions that often go unasked when somebody is looking at an investment opportunity like a multifamily syndication are the fact that it's involved with people. So as many of you saw during COVID, things changed that had never really been experienced in our society, and we went through lockdowns and things, and all of that was brand new. So the good operators immediately reached out to their tenants. The bad operators didn't. And the reason I say good and bad is because the good ones found themselves with less than 10% of their tenants not able to pay. And the other ones found themselves with almost as high as 25%. But it oftentimes came down to how that operator dealt with their people. You see, owning a multifamily is about people. You're dealing with a lot of people and a lot of families. So if everybody in your property, say, works at the local county shop and the local county shop gets shut down, well, everybody on your property is going to be impacted. So you want to do everything in your power to help those families do whatever it takes. So I knew of operators who brought unemployment workers to their facilities because the unemployment offices weren't open. I know operators who reached out to their individual residents and not only asked them about their situation, but they asked, how can we help? What can we do? And then sought out those needs. So they reached out to churches in the area. They brought in different resources. For instance, local farmers that couldn't sell their produce because places were shut down. So they brought them in, and then they had basically like open air food markets and things to help provide food for their tenants, to help provide money and things to this. But you had to get creative. Not all operators are going to do that, nor are all operators going to think like that. So when you're really asking these questions that are in my book, you're going to really find out who that operator is. What are they truly about? And what are they trying to accomplish? Because at the end of the day, there's always going to be investment opportunities that are out there. The goal is, what is your goal? Is your goal to get a good return? Is your goal to impact a community? Is your goal to set up your college money for your kids so that when they become ready to go to college, the funds will be there? Is your goal to maybe provide for your retirement and you want income and cash flow coming in, so you're building up your retirement accounts? See, whatever your goal is, you'll want that goal to align with whatever investment you're choosing. So in this case, with the multifamily syndication, you're going to be looking at the returns. Now again, these are projected, because a lot of investors will go out there and say, we're going to raise the rents and we're going to do this and we're going to do this. But in actuality, they may not be able to, because if they raise the rents too high, that market won't accept it and they won't be able to get them filled at that price. If they don't raise them high enough, they may not be able to cover the costs that they need to renovate or rehab those units, when many of them may need to be brought up to code. So it's a projection, and it's based on experience. So how well experienced are those operators? How well experienced is that team that's working on it? These are all questions that many people will think to ask, but you won't always necessarily think to ask some of the other ones that we have in our book. Remember, I have 16 of them. The reason I have 16 is because I felt that when you ask these 16 questions, you not only know the goal of the operator, you know if it aligns with your goals, you know your risks that are involved, if they're mitigated or not, if there's a way to put a buffer against potential risks, and you'll sleep better because you're going to know that your investment's going to be taken care of, but it's also going to give you peace of mind because you and your goals are being taken care of. One of the things that might have brought you here is you're looking to invest in multifamily. You don't know any operators. and you don't even know where to begin. So an operator, again, another word that you want to know, an operator simply means the person or group of people that are in charge of running the property on the day-to-day basis. So usually that's a GP team. GP stands for general partner. LP stands for limited partner. When you invest, you become a limited partner, which means everything that comes back to you is through passive activity. And that's what the government likes and wants to reward that. And in doing so, if you're doing it smartly through a retirement account or in passive ways, the tax rate is much, much lower. So those are great ways to build out accounts that are set aside for retirements or college or things of that nature, but also to avoid paying even more taxes. But the other thing about that, when you're investing in a multifamily syndication that people forget about, is the depreciation that they also get on their K1. So if you're a high net worth individual and you pay a lot of money in taxes and you're looking to find ways to save money on your taxes, then investing in a multifamily syndication is a great way to do that. But you need to know what questions to ask, right? So depreciation is that money that the government says we get to depreciate our assets. So we buy this big, beautiful, or maybe very, very ugly apartment building. And in that time of us owning it, the government says we get to depreciate it. Now, we could depreciate it over 27 years, but that's a long time. And oftentimes it makes more sense for us to speed that up. That's called bonus depreciation. When we speed that up, that depreciation gets passed on along to all the investors who own the property with us. So for instance, if you've invested $100K into a property, that year on your K1 reporting, you might get $50,000 in depreciation. That depreciation offsets in your taxes. So understanding that and understanding, wow, that's a great way to save money on my taxes. I definitely want to get involved in multifamily syndication. Again, you want to ask some more questions. You want to ask yourself, okay, how do I find these operators? Operators like us are everywhere. Now, you can always find multifamily syndication operators, Google, right, things of that nature. But oftentimes you want to know more about that person. You want to know about their company. You want to know about their track record, things of that nature. Again, all questions that are in our ebook, but as a multifamily operator, you want to know, have they ever maybe gone full cycle? Sometimes what happens is we have a lot of operators that are out there now that their experience is not going full cycle, which means they've only held a property for 1 or 2 years and then they sold it off. Going full cycle can refer to generally a 5 to 7 year hold because it's long enough to kind of see things in that market. It's long enough to do a full renovation, but it's also long enough to decide, are we going to refinance the property, pay all our investors back their principal, and then keep it and keep cash flowing, or are we going to simply sell the property? Many of them have the mentality of simply selling it. So then every time you're having to look for a new deal and a new deal and a new deal, which is one strategy, and that may be great for you, and you may 100% want to do that. But not every property makes sense to sell. See, as multifamily syndication operators, we are also in this field of build to rent. So we're building our own brand new properties as well. Now, if we're building the product, we know exactly who we're putting in there. We know any flaws or problems that have come up. Does it make sense to sell that property once it's stabilized? Well, no, of course not. So if it doesn't make sense, we don't want to hurt our investors. We want to help our investors. And if our investors' goal was to build long-term wealth and we are going to keep cash flowing on a property and we know exactly, that is a fantastic way to do it. If our investors' goals were instead to have very large capital gains because they want to turn them over and keep reinvesting and do things like that, well, then that may not be as wise a strategy and they may prefer that we sell. So as multifamily operators, we always want to do what's best for our investors. And knowing who our investors are and what their goals are is very important to us. So we would encourage you to take the time, book a call with us. When you do, we're going to ask you some questions about what your goals are and see if you're a good fit with operators like us. You see, not everybody is going to be a good fit. Not everybody wants to be impact driven. What that means is when we do multifamily properties, we're not just renovating properties, we're building out a community. So we focus on that community holistically. We're working with local churches in the area. We're working with local 501c3s in the area. Anything that we can do to help build a community where people feel safe, respected, and they feel good about where they live. So when they do that, they know who their neighbors are and they're looking out for their neighbors. Or if they just want privacy, they get that too. Whatever it is, we're building that out in our communities because our people come first. Our people come first on our properties, our investors come first in all of our deals, and our team members have to reflect that. So again, if we haven't built a solid team that understands our goal and who truly comes first, then our teams tend to fall apart. So we've had to work very, very hard to be very selective about our key teams. So our build to rent team that focuses on the new builds and building out those communities has well over 20 plus years of experience. All of us, every single one, not combined. Our developer has 20 plus years experience. Our finance and underwriting has 20 plus years experience. We have 20 plus years experience. Our entire team collectively has more than 100 years of experience in all these different areas. What that means is when we take that experience and we translate it into our investments, we mitigate a lot of risk. Because we've seen a lot of things happen. We've seen market cycles come and go. We've seen trends come and go. We've seen lending institutions come and go. We've seen a lot of things in our history. And because of that, we're able to do things because we know that. Because you don't know what you don't know. But if you've been through it, now you know it. In our situation, we have been through a lot as a team. So recognizing that and asking those questions and realizing, what is this team built for? Those are all questions that are in our book. Click the link, get our free ebook. Take the time. It's a very fast read. I promise. 16 questions and why these questions are important to you. You can have it done in 10 minutes. Super easy, super simple, but you'll be thanking me for it. So if you're ready to look at multifamily syndications and you're ready to get started with some great returns backed by hard assets in real estate and risks that are mitigated, and if that's you and you're wanting to take that next step, click on the link and book a call with us. It's a quick 20-minute phone call, not a Zoom call, just a phone call. We'll ask questions of you and your goals and what you're trying to accomplish. We'll listen to what those are, and then we'll tell you what our goals are, and we can see if we align or not. If we're not a match, we'll let you know that. If we're a match, we'll let you know what opportunities are available to you. It's simple, it's easy, and it's a great way to get started passively, but also in a way that compounds your effort. So you're not spinning your wheels, you're making great returns, and you're reducing your risk. If that's you, click on the link. We'll talk to you soon. Bye for now.